Welcome. Today we're diving into the essentials of business income under Malaysia's Income Tax Act 1967. Business income is a key category of taxable income, specifically covered under Section 4A of the Act. It refers to profits or gains from any trade, profession, or vocation carried out in Malaysia. Unlike passive investment income, business income is considered active because it's generated from ongoing, systematic commercial activity. Understanding how business income is defined and taxed is crucial for entrepreneurs, professionals, and anyone running a business in Malaysia. Let's start by exploring the legal framework that governs business income. Main legal reference for business income is Section 4A of the Income Tax Act 1967, which focuses on gains or profits from a business. Several related sections provide further details. Section 2 defines what constitutes a business. Sections 33 to 39 outline rules for allowable and disallowable expenses. Sections 42 to 44 cover aggregation reliefs and deductions, and Schedule 3 deals with capital allowances for business assets. These provisions collectively shape how business income is identified, calculated, and taxed in Malaysia. Under Section 2 of the Income Tax Act, business is broadly defined. It includes any profession, vocation, trade, or even a one-off adventure in the nature of trade. However, it specifically excludes employment. This means that whether you're running a shop, providing professional services, or engaging in a single property transaction for profit, you could be considered to be carrying on a business for tax purposes. The definition is intentionally wide to capture a variety of commercial activity. Business activities come in many forms. Common examples include trading in goods or services, manufacturing, professional practices such as law, medicine, or accounting, real estate development, agriculture or plantation operations, transportation and logistics, and running hotels or restaurants. Each of these activities, when carried out with a profit motive and organized structure, falls under the scope of business income for tax purposes. To determine if an activity qualifies as a business, several characteristics are considered. First, there must be a profit motive. The primary intention is to make money. Second, the activity should be continuous and systematic, not just a one-off event. Third, commerciality is important, meaning the activity is organized with proper systems and records. The scale of activity also matters. It should be significant rather than casual. Finally, even a single transaction can be a business if it's an adventure in the nature of trade, like buying and selling property for profit. Business income in Malaysia is taxed on a source basis, meaning only income derived from activities within Malaysia is taxable. The basis period typically follows the accounting period ending in the year of assessment. Income is recognized on an accrual basis, which means it's taxed when earned, not necessarily when received. This approach ensures that all business profits generated in Malaysia are properly captured and taxed in the relevant year. Calculating business income involves several steps. First, determine the gross income, which is the total receipts from business activities during the basis period. Next, deduct allowable expenses that were incurred wholly and exclusively for producing that income. The result is your adjusted income. Then deduct capital allowances for qualifying business assets to arrive at statutory income. After that, combine all statutory incomes from different sources to get aggregate income. Finally, apply any reliefs or deductions, such as business losses or donations, to determine the chargeable income. Not all expenses are deductible for tax purposes. Under Section 33(1), only expenses that are wholly and exclusively incurred in producing gross income are allowed. These must be revenue in nature, not capital, and must not be specifically prohibited under Section 39. Common allowable expenses include salaries, rent, utilities, advertising, delivery costs, interest on business loans, audit and legal fees, bad debts written off, employer contributions to EPF, and repairs to maintain existing assets. Let's look at some specific examples of allowable business expenses. Operating expenses like salaries, rent, utilities, and stationery are deductible. Selling expenses such as advertising, delivery, and commissions also qualify. Finance costs, including interest on business loans and bank charges, are allowed. Professional fees for audits, tax agents, and legal services related to revenue matters are deductible. Bad debts that are proven irrecoverable, employer contributions to EPF within statutory limits, and repairs to maintain existing assets are all considered allowable expenses. Certain expenses are specifically disallowed under Section 39. These include private or domestic expenses, capital expenditures such as purchasing land or equipment, depreciation, since capital allowances are given instead, fines and penalties, income tax payments, non-business-related entertainment, and donations to non-approved bodies. It's important to distinguish between revenue and capital expenses, as only the former are generally deductible for tax purposes. Capital allowances are tax deductions given for the wear and tear of fixed assets used in a business, replacing depreciation for tax purposes. There are two main types: initial allowance, which is granted in the year the asset is first used, typically 20%, and annual allowance, which is given every year the asset is in use, usually 10-20%. Qualifying assets include plant, machinery, vehicles, office equipment, and computer. These allowances help businesses recover the cost of their capital investments over time. If your business incurs a loss in a given year, you can set off current year losses against income from other sources in the same year. Unabsorbed losses can be carried forward indefinitely, provided the same business continues to operate. This is governed by Section 43(2) and Schedule 4 of the Income Tax Act. The ability to carry forward losses provides valuable relief for businesses facing tough times, helping them recover and grow in future years. Business income can arise from various sources. The sale of goods or services is the most common and is fully taxable as business income. Professional fees, commissions, or brokerage earned from business activities are also taxable under Section 4A. Even income from a side business or a one-off adventure in the nature of trade, such as buying land to sell at a profit, is considered business income and subject to tax. The key is that the activity is profit-driven and commercial in nature. Let's walk through a simplified example. ABC Enterprise has gross sales of Rm 500,000 for the year. After deducting allowable expenses of Rm 300,000, the adjusted income is Rm 200,000. Capital allowances of Rm 300,000 are then deducted, resulting in statutory income of Rm 17,000. If ABC Enterprise qualifies as an SME, the tax rate is 15% on the first Rm 150000 and 17% on the balance, according to the 2024 budget. This example illustrates the step-by-step process of arriving at chargeable business income. It's important to distinguish between business income and investment income. Business income under Section 4A is active, continuous, and organized, with full deductions allowed for expenses and capital allowances claimable. Investment income under Section 4C is passive, derived from assets like rent, dividends, or royalties, with limited deductions and no capital allowances. Understanding this distinction helps ensure correct tax treatment for different types of income. Let's recap the key points. Business income arises from systematic, profit-driven commercial activity. Only Malaysian-sourced business income is taxable. Expenses must be wholly and exclusively incurred for business purposes. Capital allowances substitute for depreciation, and business losses can be carried forward indefinitely, subject to certain conditions. The tax system also offers incentives and exemptions to promote entrepreneurship and investment in Malaysia. Here's a quick summary of the main concepts and their legal provisions. The definition of business is found in Section 2, chargeable income in Section 4A, allowable expenses in Section 33, disallowable expenses in Section 39, capital allowances in Schedule 3, business losses in Section 43, 2, and exemptions in Schedule 6 or the Pioneer Incentive Act. This table helps you quickly reference the relevant sections when dealing with business income tax matters. Malaysia's tax system offers various incentives and exemptions to encourage entrepreneurship and investment. These include pioneer status, reinvestment allowances, and special SME tax rates. Such incentives are designed to support business growth, innovation, and national economic development. Understanding and utilizing these incentives can significantly reduce your tax burden and help your business thrive. Accurate and organized record keeping is essential for businesses to comply with tax laws. Proper records help you track income, expenses, and asset purchases, making it easier to claim allowable deductions and capital allowances. Good documentation also ensures you're prepared for any tax audits and helps avoid disputes with tax authorities. Investing in reliable accounting systems pays off in the long run. Many businesses make mistakes such as claiming non-allowable expenses, failing to distinguish between capital and revenue expenses, or not keeping adequate records. Others may overlook capital allowances or forget to carry forward business losses. Being aware of these common pitfalls can help you stay compliant and optimize your tax position. When in doubt, consult a tax professional for guidance. Summary: business income under Section 4A of the Income Tax Act 1967 forms the backbone of Malaysia's income tax system. It ensures that profits from commercial activities are fairly taxed, while also providing incentives to foster entrepreneurship and economic growth. By understanding the rules around business income, allowable expenses, capital allowances, and loss relief, you can manage your tax obligations efficiently and support your business's long-term success.